Get Rich Education is brought to you by Reef Oil Gas Companies, partners in American energy production for world consumption.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, Show 18. I'm Keith Weinhold. With listeners in 97 countries, it's the show where I've been giving away my best investment knowledge and experience, and I've even been hooking you up with my contacts, sometimes bringing them onto the show like I've done today. Hey, you can listen to our show on iTunes, where most people have been finding us, or for Android users, Stitcher Radio is probably the most popular option. Do people even call it Stitcher Radio anymore? I don't know. It's Stitcher, the Stitcher app. Then there's all those aggregator apps you can use for learning to build your wealth through Get Rich Education, like Pocket Casts. We can be found too on Overcast, Downcast, and Instacast. But hey, it's pretty cool to be heard in 97 countries across those platforms. I'm grateful for that. A couple of those countries only have one listener checking in, like Azerbaijan and Laos. So I appreciate that listener in Azerbaijan, just like all the other listeners. Maybe I'm even more grateful that I'm not in Azerbaijan. Sounds like a happening place. So, hey, I'm freshly back from the real estate syndication seminar in Las Vegas. And you probably wonder, what's a syndicator? A syndicator is a person that goes out and finds the real estate deal. Oftentimes that's a large multifamily apartment building, but that syndicator does not have the money for the down payment, his or herself. So what that syndicator does is they pool other investors' money together to make the down payment on the property. The syndicator has to do all the due diligence, in other words, the research on the property, get it under contract, close the deal, and do it all per IRS regulations, typically in conjunction with an attorney to steer that process. It's kind of a natural progression for people, but a lot of people just don't know about syndication because every real estate investor runs out of their own money at some point. Yeah, it was kind of cool. I met some Get Rich Education listeners there at the syndication event, so it was really great to have a meal and a drink with them after the seminar each day, talk to them about what they've liked on this show and what they want to hear more of on future shows. So, hey, well, another use of real estate investing is directly investing in oil and gas wells that sit on top of that real estate. Mike Mauceli, CEO of Reef Oil Gas Companies, is our guest on Get Rich Education today. He's not just some guy that I have to talk about his investment here on the show. I know a lot of prominent, notable people at the very top of the investment education world that invest with Reef. If I named some of them, you would have heard of them. But that right there is not necessarily a reason for you to invest, though. You need to make your own decision. I've been an investor with Reef for more than 3 years, and I've been pleased with my 38 consecutive months of cash flow returns. About 3 years ago, both I and my right-hand man here at Get Rich Education, John, sat down in the boardroom at Reef corporate headquarters in Richardson, Texas. We sat with Mike Mauceli and our broker that works for Reef, Garland Benton, to discuss the investment. So I know these people. And I see Reef around at trade shows that I go to, like the New Orleans Investment Conference. So they're real people, and they've been in business some 25 years or so. Well, I certainly don't know as much about oil and gas investing that I do in residential real estate. One thing I do know is that they only invest in America, so that leaves some people with something to feel good about. And the really important thing is that it has a cash flow. It produces monthly cash flow distributions. And that's one of the things that I most like about residential real estate. It has that cash flow. It makes money follow you. Don't follow money, make money follow you. These Reef Oil and Gas investments too provide tax benefit, a fantastic tax benefit. And, it's something that's like totally uncorrelated to residential real estate. Reef investors were pretty happy back in 2008 when oil was $140 a barrel and we were in the height of the mortgage meltdown and housing values lost a lot of money. So at that time, reef returns provided a lot of stability to that real estate investor that had their portfolio cracking apart depending on what market their real estate was invested in. So it can really bring cash flow stability to a portfolio since it is uncorrelated. I'm also going to ask Reef how they get paid when an investor invests with them. After I already know what my returns are going to be, I kind of want to know that an investment company that I've invested in is going to be profitable. Just like when I sit down with my real estate property manager every once in a while, sometimes I just pop my property manager the question and I ask them if they are profitable themselves. I want them to be profitable. I want my manager to stay in business because that supports the stability of my business. That's part of my abundance mentality. I have two friends, like really close friends that are Reef investors too. One of those two friends says that Reef is the best investment that he's ever made, even more so than his investment real estate. He just likes the certainty and the unmessiness of the Reef oil and gas returns. Like, even though that friend of mine uses a property manager, he just doesn't like getting those disruptions or questions from his property manager like, hey, should I replace this washing machine or should I have it repaired, or a garage door needs to be fixed or whatever. He just doesn't like that uncertainty. He just wants things to be as hands off as possible. And with my experience in investing in Reef, there's even less to manage or maintain for an investor than there is in investment real estate. So in today's interview, first I'll ask Mike about their business operations, and then I'll ask him about how the Reef opportunity looks for you as the investor. I disclose that I am a Reef investor and that they are an advertiser on this show, okay? And this is not an investment advisory show. It's an investment education show. I can't directly endorse Reef, and I'm not an investment advisor or a tax advisor, so please listen to the disclaimer at the end of the show and do your own due diligence. So, hey, speaking of tax advisors, I am going to have one on the next show, show 19. It's going to sound like I'm bragging here, but as I typically have the most prominent expert in their field appear on the show, I am having the world's best tax advisor on the next show. He's one of Robert Kiyosaki's elite rich dad advisors, and his name is Tom Wheelwright. If you've been investing in real assets for a while, you're already familiar with Tom. He's the only person in the world that I've ever seen make taxes interesting. Yes, I said make taxes interesting. And he tells you how to make your wealth tax-free. Tom is also very familiar with Reef because his firm does tax strategies for a lot of Reef investors. I actually invest quite a healthy amount with Reef because they're one of the good, reputable energy companies with a long track record. And, something else that might be attractive to a prospective Reef investor is that unlike when you go get a real estate loan with Reef, you don't have to show several months of liquid reserves in your bank account after you've already made the investment. You don't have to have a certain debt to income ratio like you typically do for getting a Fannie or Freddie backed mortgage loan. It doesn't matter what your credit score is when you invest in Reef. It's mostly just about having the minimum investment money, which is $10,000 in this case, and you don't need to have accredited investor status like I did when I invested with Reef 3 years ago. It was different then. You can use retirement funds to invest in Reef too. Reef will help steer you in getting that process started. So I think today's show is going to be on the longer side because it takes time to describe an investment that many people aren't familiar with. And I also don't have the depth of knowledge in oil and gas investing like I do in residential income properties. So I can't speak to this much on other shows. So let's get it going. Mike Mauceli is the founder and CEO of Reef Oil Gas Companies. In his 26 plus years as CEO, leading the growth of the organization from 3 full-time employees in 1987 to today where Reef is a larger company, Mike is now one of the most influential CEOs in the oil and gas community today. Welcome to Get Rich Education, Mike Mauceli.
Well, thank you very much, Keith. I'm certainly happy to be here and talk to you a little bit about oil and gas.
So you offer sort of a different product in the way most people are used to investing in oil and gas. Usually when someone thinks about investing in oil and gas, they think of perhaps a mutual fund or an individual stock like an Exxon stock. So what are the benefits of what you offer where an investor can more directly invest in oil and gas?
Well, we actually offer a program that allows the investor to directly participate in oil and gas. And that way they can enjoy the tax benefits that are offered by the federal government, but also they can directly participate in the actual drilling, completion, and production of oil and gas. So it's a little bit different than in the normal stock market where basically you're investing in a company and your investment is obviously has a lot more to do with the company's overall performance than participating in a certain area of the industry.
And I think you'd agree that one distinct difference between direct investing in oil and gas, like with Reef, versus something like Shell oil stock, is that the tax benefits are clearly a lot greater when one invests more directly in oil and gas. And we're going to have Tom Wheelwright on an upcoming show, Rich Dad's tax advisor, and I'm going to ask him a little bit more about it. Listeners, neither Mike nor I are tax advisors, but I think Tom is going to come on here and tell us about how you get a significant tax deduction in the same year that you invest with a Reef Oil and Gas Fund. You get the benefit of depreciation and depletion and so on. In fact, I've even heard Tom go on to say that with oil and gas investing directly, the tax incentives are so significant. In fact, they're probably better with direct investing in oil and gas than they are with real estate, something that a lot of people don't know how to speak to.
Well, that's true, Keith. I mean, oil and gas is, I guess, and has been the number one tax advantage offered for investors. In fact, a lot of your financial planners around the country, they use investments in oil and gas.
I don't know about foreign investors, but I know the United States typically provides terrific tax incentives to those members of society that provide the rest of society with housing, food, jobs, and energy, because typically the public sector doesn't do a very good job at providing those things. So basically, if you provide others with housing, food, jobs, or energy, like with Reef Oil and Gas investments, you typically get terrific tax benefits. So in direct oil and gas investing, one investor fear is that you're going to go hit dry wells and then the investor is going to lose all of their money. I mean, how is that risk mitigated in your business model? And do you have exploratory well types versus developmental versus ones that are already producing and you can buy into that production? How does that look for the investor, Mike?
Well, the overall industry has changed a lot, Keith. I started my company over 27 years ago, and of course, back then, I mean, the only way really to find oil and gas was to go out and literally explore for it. And a lot of times, you would go out and you would drill 7, 8 unsuccessful wells before finding a field and then, of course, being able to develop that field. So prior to 2008, before, a lot of the shale drilling took place, and say, for example, the Bakken of North Dakota, the Eagle Ford Shale of South Texas. I mean, it was literally a hit miss. I mean, you had to basically go out and explore and, and as I said a little bit earlier, I mean, you're going to drill a number of dry holes before you find a field. But today, if you're participating in some of the shale plays, these are very vast areas. And when I say vast, I mean, like, for example, the Bakken, which is one of our core areas, the size of that play is really about 250 miles north-south and about 150 miles east-west. So you've got a very vast area that has very tight oil and gas shales in it that are basically saturated with oil and gas. So the way you get that out is with horizontal drilling. So our industry has changed a lot today. If you're participating in one of these shale plays, you're not going to drill a dry hole. So every well you drill, they're going to complete that particular well. I think we've participated in close to 900 wells, and I think out of those 900 wells, we've literally had 2 dry holes, and they were basically because of mechanical issues and not the fact that, that we did not find oil and gas. But still, the question is, it's one thing about drilling a well and finding oil and gas, but there's another thing about drilling a well, finding oil and gas, and making a return on your investment. And I think that's where companies today have to be focused on, because even though these plays are very vast, very large, there are marginal areas in these plays where, you may only recover, say, for example, a small amount of oil, and you don't ever make your money back. So as a company like ours, what we try to do is to understand the play. You say you have a lot of real estate investors. This is a lot like real estate where, you've got to put yourselves in the best neighborhoods. And how we do that as a company, for example, in the Bakken, we went in back in 2010 when we entered the play, and we did a study of the entire basin. In fact, we contracted with one of the largest engineering firms here in the United States to go in and look at the entire basin of the Bakken to determine where the better wells are. Investors today have a real benefit because there's been close to 10,000 wells drilled in the Bakken. I think the average out there is saying, when the play is totally developed, there's going to be close to about 35,000 wells drilled in it. So today the play is about a third developed. And where that benefit is for investors coming in today is that now you've got production histories. The basin has been outlined where the better areas are. So you're able to make more, correct decisions on where you want to participate in the basin.
So I'm hearing that investor risk is sort of mitigated now that we have horizontal drilling, because prior to this hydraulic fracturing technology, it was sort of like we were at the surface and dipping a straw vertically down into the ground, which is more likely to miss a pool of oil, if you will. And now we have the ability to go ahead, dip that straw down, turn that straw horizontally, and go find the pool of oil, to use layperson's terms. Does that sound about right?
That's correct.
So yeah, just like residential real estate, like you mentioned, you still have to know what property type to invest in real estate, or you need to know what geology to invest in oil and gas development. So you do have a full staff of geologists and engineers. I read that on your website. Do they help you with the exploration and identifying the best places to extract the oil?
Yes. In fact, I think we can run through kind of a scenario of how we look at a project.
Yeah, how's that look?
Once we bring a project into the company and say we've been contacted by another company, or we're going to try to make an acquisition, the first thing we do, Keith, is we go out, and our geologists, like you said, we do have our own geologist. For investors out there, geologists are people that actually study the rock. And then we have reservoir engineers, we have drilling engineers, we have a completion engineer. And then, of course, what we try to do as a company is that we'll bring this opportunity into the company. And the first thing we want to understand, is the rock. And there are a lot of different types of rock that produce more oil and gas than others. So we want to understand, are we in the right area from a geological standpoint? And if that makes sense, then we want to look at, the actual reserves. If we're looking at making an acquisition that already has producing properties with it, and by the way, that is our business model. What we are trying to do is we try to go out and we try to purchase existing production, which is buying existing cash flow, and then we want to drill upside or drill up. We want to have opportunities to basically increase the value. It's kind of like in real estate when you're trying to do a value add property. You're buying a property that's throwing off existing cash flow, but then you want to add value to that property by drilling new wells. Same principle, our reservoir engineers will go in and we'll look at what the remaining reserves are for that particular property. For example, how much oil has been produced out of it, how much oil is left to be produced out of the existing wells, so we can formulate an offering price to offer for that particular property. Our geologists, they are looking at the surrounding wells to determine how much production has been produced out of those wells and what the potential is when drilling new wells. Are they in a good area? Have the wells around us performed as good as what our economics are showing or what our potential bid price is going to show? And then, of course, our drilling engineers, we currently buy producing property under some of the best operators in the Bakken. We are what they call a non-operator in the Bakken, and simply the reason why we've chose to go that route in these particular areas because you have to drill a number of wells in these plays, and of course the average cost of a well up here now has come down a little bit since the price of oil has come down, but it's still running in the neighborhood of about $9.5 million to $10 million per well. And we currently own interest under about 47 different operators in the Bakken, so we want to understand from a drilling perspective, which operators are the best at far drilling the wells, and the same thing from our completion engineers. We want to understand which one of them are using the best techniques, because a lot of times in these unconventional plays, it's you're drilling a horizontal well, meaning that you're drilling a well on the surface that's going to go down 10,000 feet, and then you're drilling a horizontal lateral well 10,000 feet. So you're actually drilling a 20,000 foot well.
So we're talking about hydraulic fracturing, aka fracking, which constitutes some horizontal drilling. You mentioned the depth, which I know is below most or really all water tables. What kind of interests does Reef have in reducing environmental impacts of this activity?
Well, I think, the oil and gas business has historically got a bad rap as far as environmental issues. I mean, if you look at our industry overall, we're probably the most heavily regulated industry from an environmental standpoint out there. And the horizontal drilling has done great strides as far as reducing the actual footprint on the surface of wells. And now you can drill multiple wells off of one pad location. So basically you have a much smaller footprint on the surface, which doesn't impact the environmental. And you are correct in saying that, the majority of our wells are drilled below the water table. The average water table in the U.S. runs about 1,000 to 1,200 feet. The zones that we are drilling for, whether it be the Bakken or whether it be the Eagle Ford or whether it be some of your, deeper plays out in West Texas, are all at about between 8,000 to 10,000 feet deep. So when a well gets drilled, you have several strings of casing, and that is pipe that is put in the hole. You start out with a much larger diameter pipe, and you reduce that hole size or that pipe size as you go deeper. But the first thing that is done in any well is that you drill past the water table, and then you cement that pipe all the way back to the surface. So the water table or the fresh water tables are completely sealed off. And then when the well is drilled down to 10,000 feet, then there's another string of pipe that is run in the hole and is run all the way down and cemented back. So you have quite a bit of insulation between the actual oil and gas formation and the freshwater zones that where we get our fresh water from. Those are completely sealed off. And then, of course, when you hit the zone, you're drilling horizontally that 10,000 feet. So then you come in with your hydraulic fracturing technique, where you're going in and you're actually pumping sand and water. I mean, frac fluid is usually made up of about 96-97% water, and then the remaining, the chemicals that are used are usually the same chemicals that are used in our food industry that basically are used in our food. So it's very biodegradable. So the water and the chemicals is used as for example, a carrying agent, which carries the sand out. And in most cases, you're using basically a beach sand to fracture the well. And then, of course, you can also use, as we talked about a little bit earlier in the presentation, an artificially man-made proppant. And simply what that does is it gives you more crush strength. So when you frack a well, you're basically pumping this gel and this this sand in under high pressure, and that causes the earth to create little fractures in the rock or in the shell. And then, of course, as you release that pressure, then when the earth tries to close back, you basically have sand that has allowed these fingers to stay open that you've created in the shell. So that allows your oil to flow into your wellbore. But again, and from an environmental standpoint, we are all very environmentally conscious in our industry. And as I said, it's probably one of the most heavily regulated industries out there.
One thing I'm interested in as an investor, when I'm not going out and buying a multifamily apartment building where I own the whole thing, fee simple, if I'm going to go ahead and invest in a fund like Reef, even if it's direct investing, I have a pretty good feeling if the company themselves have skin in the game. Does Reef invest their own money alongside individual investors in any capacity?
Yes, we invest in every program, some more than others. Our current public fund that we have on the street, we are purchasing 6% of the units that are sold. So, for example, if we go out and we raise $20 million in this particular fund, then obviously we will have an investment of about $900,000 right alongside the investors.
So why do this? Why have this business model that's unconventional? Why don't you just go public and list your company on the New York Stock Exchange and go ahead and offer interest in your company that way?
Well, a lot of companies today are trying to go private. They're trying to get away from the public markets, but obviously it's just a different way of accessing capital. We've had this business model for the past 26, 27 years, and we work with private investors and we work with financial planning firms around the country. We also work with larger institutions on making acquisitions as well.
So you do accept institutional investor monies into your funds as well as individuals like me, or is it for individuals only?
Well, not in our fund. For example, last year, we worked with a very large New York firm that we were handling all of the evaluations for them. They don't have their own staff of geologists and engineers and stuff. They're basically a financial firm, a public company. So we bid on over $1.5 billion worth of properties last year with this company. Under our agreement with them, they're not participating in our fund. They participate alongside of us, which is a benefit to us because it allows us to invest. It allows us to go after much larger acquisitions. And for example, if we're successful in getting an acquisition, our fund may buy 10 to 20% of the acquisition, and they would put up 80% of the money to acquire the other part of the acquisition.
How exactly does that work? I don't understand that. There's a financial...
Well, we work with a large public company. They are an investment company, and they don't have a staff of geologists and engineers, but they want to invest in the energy industry. So what we've done over the last year, we have bid on over $1.5 billion worth of properties. Unfortunately, we didn't buy one because we came in second a lot of times because people were willing to pay more money than we were. And as you know, in the acquisition arena, if your clients have been involved in real estate, obviously there's a lot of money out there chasing good deals. And so the bottom line is what we've done as a company is that we have, we evaluate these opportunities and say, for example, if an opportunity that we're evaluating is the bid price is going to be $100 million, then under our agreement with the company that we're evaluating for, we have the right to buy 10 to 20% of that acquisition, and they will purchase the remainder of it. So what it does for Reef as a company, it allows us to bid on much larger acquisitions. So it allows us to participate against some of the larger companies out there that are acquisition companies because it allows us to access more capital.
So does that basically mean that you're using leverage when you go ahead and buy a group of wells, or all cash?
Well, we use leverage when we're making an acquisition like on existing property. Now, leverage as in real estate versus oil and gas is a lot different, because in real estate, for example, you can leverage a property up, say maybe 80%, or so when you go out and make an acquisition. In oil and gas, usually the standard is you can borrow about 40 to 45% of the value of the reserves. So you can't borrow as much capital, but yes, we do use leverage.
You're listening to Get Rich Education with our guest today, Mike Mauceli. More when we come back, including the macroeconomic pictures around the price of a barrel of oil and how this investment looks for you as an investor, as far as the minimum amount that you need to put in, your rates of return, and how long your money's tied up. Right when we come back, I'm your host, Keith Weinhold. Are you looking for an investment with the potential to offer monthly cash flow and tax advantages? While prices fall at the pump, now could be the time to invest in oil and gas. In business for nearly 30 years, Reef Oil Gas Companies has endured price fluctuations and understands the importance of creating opportunities by purchasing oil and gas properties during distressed times. Primarily focused on the Bakken Three Forks of North Dakota and the Eagle Ford Shale of South Central Texas, Reef's model is designed to generate revenue and provide tax advantages from the production of oil and natural gas. For more information on this investment opportunity, go to reefogc.com.
This is Entrepreneur on Fire's John Lee Dumas. Don't follow money, make money follow you with Get Rich Education.
Welcome back to Get Rich Education. We're talking with Reef Oil and Gas Company CEO Mike Mauceli. So Mike, what about the recent drop in oil prices? We know it was $100 a barrel at the midpoint of last year, and now it's dropped significantly. From the investor angle, does that work to our advantage, or is that to our disadvantage that prices are low?
Well, oil and gas is like any other type of investment, whether it be the stock market or whether it be gold or silver or other type of commodities. You're always going to have fluctuation in the market. And of course, I think it works to the benefit of investors. Look, when I started my company, the price of oil was $9 a barrel back in 1987. And of course, so I've been in it long enough where I've seen the price go up and down. And of course, like I said, you're always going to have those fluctuations in any type of market. In my opinion, it creates buying opportunities for investors that are in on current existing projects. Of course, cash flow goes down. Obviously during the time when oil prices, drop, but it gives you an opportunity to buy in at lower prices. And, it's kind of like dollar cost average. And I look at it that way in the stock market. When prices drop, obviously you want to buy more if you're buying in a good area and you're in an area where, that has proven assets. And as I mentioned earlier, that, now is a great time for investors to be looking at these unconventional plays because, hey, all the explorers, they went out in 2008, they went out in 2010, and they basically defined where the better areas are to invest in these plays. And now you have that benefit.
Well, there's obviously always going to be a cost to getting a barrel of oil out of the ground and produced and refined and out onto the market. Should that fact there alone, does that establish a floor for prices? It seems to me if the price fell too far, the production would be curtailed and that would affect the supply, and then the oil price would be buoyed back up again. Is that right?
Yeah, in fact, I think the price actually fell a lot further than, OPEC or Saudi Arabia was anticipating it to fall. And the simple fact is the cost of these wells, for example, in these horizontal plays, the average cost of a well to drill and complete up there is about $9 to $10 million. So you have to be able to produce a certain amount of oil in order to make that well economical. And in my opinion, that pretty much sets the floor of the price. Now, Saudi Arabia, obviously, they have cheaper oil than we do here in the United States. But one thing that investors need to realize is that Saudi Arabia and a lot of the OPEC countries has not brought any new production on in 40 or 50 years. So, while they still have reserves in the ground, their oil is getting more expensive to produce simply because they don't have a lot of new reserves coming on. And where the Saudis have said in the past and a lot of other countries, where they feel the floor is or where they would like to see the price of oil stay is around $85 a barrel. Now, over the last several years, obviously there's been a lot more oil brought on here in the United States from the unconventional shale plays. And so as the price dropped, companies have cut back on drilling. So I believe that oil takes a natural cycle. And as drilling gets curtailed and new production coming online gets curtailed, then obviously the markets pretty much level out themselves.
Yeah, so, unlike real estate, which is something local, location, dependent on local demographic factors and job growth and so on, instead, oil is a global economy. It's produced in one place, and then it's distributed nationally or even internationally. So can you talk a little bit more about OPEC or, maybe an unpredictable Putin in Russia, how they affect prices and ultimately how that can affect the cash flow for the reef investor?
Well, it's all going to come down to oil prices. One of the things that it's done is that it has really crippled the Russian economy. It's driven the ruble down, and, basically Putin has had this, idea about trying to curtail natural gas in order to move his political agenda along. And then, of course, the Saudis have been at battle, not in a war, but basically with Iran. So, over them getting nuclear weapons. And one of the ways, obviously, is in order to slow down a lot of that is to hurt them where, in their pocketbooks. And essentially that's what they've done. In the meantime, obviously they were, concerned about the U.S. and the oil currently being produced here in the U.S. and that bringing more oil onto the market. In the past, historically, Saudi Arabia has been the swing country when production needed to be cut. They were the country that obviously stepped up and cut production, and a lot of your smaller OPEC members would begin to cheat and basically to produce more oil. So the Saudis have pretty much been kind of the swing producer in the whole thing, and I think this time they just, had got tired of countries cheating while they're cutting production, so they decided to continue on with the oil that they're producing or basically continue on flooding the market with oil, and that's what's caused the downturn in prices. But now we've seen, here in the U.S., a lot of the companies, large companies have basically shelved, or cut their drilling budgets by billions and billions of dollars. So they're not shutting wells in. Obviously you can't shut these wells in as they get older in life. You have to continue to produce them. So, but just the fact that they are trimming billions of dollars off of their new budgets is going to cause the amount of new oil that's coming onto the market to be curtailed for several years. And that was one of the things I've read lately is that because of this downturn or this flooding the market of oil and driving the price down to $50 a barrel and cutting out all these new reserves, not cutting them out, but basically postponing them for several years could potentially drive the price of oil up in $150 to $200 range in the future. Because one thing that I think everyone needs to understand is that population growth is still continuing. Right now here in the United States, we use about 18 million barrels of production a day. We've produced right at about 9 million barrels of production a day. And so we're still importing, right at about 8.5 million barrels of oil a day, where the next biggest country to us that uses a large amount of oil is China. And I think they use on a daily basis roughly about 10 million barrels of oil. One way to look at it, here in the United States, we have a population of about 300 million people. China has a population in excess of 1 billion people, and yet we use more petroleum products than they do. And the same thing with India. When you look at India, India uses roughly 2 million barrels of oil a day. They have a population of over 1 billion people. So as more of these economies start to grow, and it doesn't have to be a large growth.
I've let my listeners know before that I am a reef investor myself. In fact, I made the decision to invest in Reef Oil and Gas more than 3 years ago. One thing that went into that consideration is I am already an oil and gas investor, and so is every listener that's listening to this right now. The device that you're using to listen to this podcast through, whether that's an iPhone or an Android device, there is oil in that, and you don't know where that came from. When you invest in Reef Oil and Gas, you are investing in America because Reef only invests in American oil and gas assets. So that's just something to consider that you may not think about. So, Mike, how does this actually work? How does it work for the investor as far as you're extracting oil and gas out of the ground? And how does that actually get turned into a profit for both yourself and for the investor? How does all that work? What's in it for you? What's in it for the investor? And how does that go from a producing gas well to a return?
Well, for example, one of our products is our public fund product that was out there. And as we talked about a little bit earlier, we participate alongside the investors and we buy 6% of the program. For example, the investor puts up, out of $1, out of that $1, or say $100,000, whatever the amount is, but to make it simple. So when an investor invests $100,000 into a program, and there's a certain amount of tax benefits that are on the front end of that. Now, if you're drilling an individual well, for example, and you're in a 37% tax bracket, then you're able to write off up to 65 to 70% of that investment on the front end. And so if you're investing in individual wells and you put that amount of money in it, then the federal government is roughly, investing somewhere in a neighborhood, and this is an estimate of about $24,000. So the investor's actual investment is right around about $74,000. So you're getting a tax break on the front end in drilling wells. Now, when you buy producing properties with upside drilling potential, which is what we do as a company, then you're basically buying cash flow on the front end. So you don't get to take a tax deduction for buying that cash flow, but you do get depreciation and you do get a depletion allowance. And the federal government allows you to take up to 22% of the depletion allowance against your current income. So out of every dollar you make, 22% of it's tax-free. Now, new drills, as wells are being drilled, then we do get those same, what we call intangible drilling cost deductions, or what we call IDCs. And those IDCs, we can write off up to 75% of the actual drilling. Now, what an IDC is, an intangible drilling cost, is basically anything intangible. Like the pipe is not, you can't write off the pipe because that's something you can touch. But the actual drilling of the well, the actual hydraulic fracturing of the well, everything it takes, as far as to drill that well that is intangible, you can write off up to 75 to 80% of that. So what we've been able to accomplish as a company is by buying existing properties and participating in new drilling, we've been able to basically cover all of our cash flow where it's tax-free because of the IDCs. So the intangible drilling cost deductions. So how we invest in a project, say, for example, you put in $100,000, well, we get a carried interest of 10% on the front end. We're buying 6% of the units available. So the investors, 90% of their money is going into the ground or into the existing property. So 90%, 90 cents out of every dollar goes into that property on the front end. So now there is a commission on the front end. If you go through a broker or you go through a financial planner, there is a commission on the front end as well. So, that commission obviously taken off before it goes into the ground. But so the investors will receive 100% of their money back first. And then once they get 100% of their money back, then I think we back in for another 10%. So we end up with 20% of it, and the investors end up with 80% of it, of the investment, once they get 100% of their mony back. So the end, what we're trying to do is we're trying to buy that cash flow. We're generating monthly returns to the investors. The investors get a distribution check. When the wells are producing, they get it on a monthly basis. And then we've got a 5 to 7 year hold period. In about 7 years, we want to divest of that asset. Now, that's all going to depend on what oil and gas prices are doing. For example, today we wouldn't want to divest of that asset, obviously, with prices being lower. So we would just hold on to the asset, continue to produce it. Once prices started to rebound, then we would look to divest of it.
Okay, so an investor's funds are typically tied up 5 to 7 years, depending on the fund, which is pretty much what a real estate investor is used to. You know, your funds are illiquid and they're usually tied up for a few years. I know that one investment unit costs $100,000, but an investor doesn't need to buy a full share or a full unit, right? What's the minimum investment amount?
In our public fund, it's only $10,000. So an investor can get in, usually if you're investing in a private program, you have to be an accredited investor. And of course, accredited investor is an investor that has $1 million net worth, or has made $250,000 a year in the last several years. We can actually, in the public participation, and we follow the same reports as a public company does. I mean, obviously, but in a public fund, we can take non-accredited investors. And different states have different accreditations, but the average accreditation for a non-accredited investor is an $80,000 net worth. And one thing I'd like to point out, because I always get asked this question, does an accredited investor get a better deal than a non-accredited investor? And the answer is no, they don't. I mean, it's the same split, same wells, same potential returns out there.
Yeah, that's one of the things I wanted to make my listeners aware of. When I got into the Reef Oil and Gas funds more than 3 years ago, one needed to be an accredited investor. And now with this public Reef Drilling and Income Fund, one no longer needs to be accredited. And this is available to really almost everybody. What are the projected rates of return with the Reef Drilling and Income Fund, and how often do you give out distributions, Mike?
Well, obviously, we're not really allowed to talk about what the current returns on the current program, but I can tell you on the past programs what we've been able to accomplish and what we're looking to accomplish. I mean, we're looking to generate somewhere in the neighborhood of about a 12 to 15% cash flow. We want to divest of the property in about 5 to 7 years. And what we've been able to generate in the past off of our income funds has been somewhere around a 1.5 to 2 to 1 return on the investment. And as we said earlier, there's always risk.
Sure.
I mean, obviously, price of oil goes down and stays down, then you're not going to generate those types of returns. So that's one of the reasons why you get the tax advantages for investing in oil and gas, because investors are willing to take that risk. So what I like to tell everybody is that, you have to be able to go into an investment and you have to be able to withstand a loss of your entire investment. But the bottom line is the way our business model works, we're trying to obviously give the investor the most conservative type of investment. We hope that we don't lose money, but, there's always that chance that you will. So you have to understand that going into it.
Absolutely. So the typical scenario for an investor would be that they would invest at least $10,000 with you. That could be tied up for 5 years or more, but they get a monthly cash flow distribution on that $10,000 during their hold period. And when the hold period is over 5 years or more, there is the expectation of getting that $10,000 returned at that time.
And plus a multiple on it, that's correct.
Plus a multiple on it. What's the multiple typically look like? I know nothing's really typical, but...
Well, as I said just a little while ago, since we're not wildcatting, I mean, we're looking to generate somewhere around a 1.5 to a 2.5 to 1 return on our investment.
Oh, that's where that ratio comes in. And one more thing to talk about, Mike, general partner shares versus limited partner shares. What should an investor consider there? Which type should they buy?
Well, let's talk a little bit about that, because obviously, in my opinion, when you're buying production, we have investors that invest for different reasons. And of course, if you have a high active income, you want to be a general partner going into an investment, because a general partner, you're able to take the write-offs against your active income. And so if you have a lot of active income and you don't have much passive income, say from real estate, basically you want to come in as a general partner.
Okay, like if someone works a W-2 job for an employer, so they can take some of that Reef money invested and use it to offset their working income from their regular job.
That's correct. And one thing to understand is if you're going to be a general partner, one of the reasons why you're a general partner is that you're just like a general partner in a partnership. So you have liability. Now, how we reduce that liability for investors is that we carry $80 million worth of insurance that covers all of our non-operators or our investors. Basically, in case there was ever some accident out there, then the way it would normally work, say if someone was out on a drilling rig and there was unfortunate death on the drilling rig, then obviously they would go out and they would sue the drilling company, they would sue the operator, and then if it got down as far enough to our investor level, then we would have $80 million worth of insurance that covered, any accident. If you're buying production, the way I look at it is that, more than likely you would want to come in as a limited partner. A limited partner, you're only liable for the amount of your investment. These investments, when you're buying cash flow in oil and gas, is throwing off passive income. So essentially, you're getting the same write-off. But if you're a real estate investor and you have a lot of passive income, or if you're buying oil and gas properties and you have passive income, you still can deduct the same IDCs. Being a limited partner, you just deduct it from your passive income. So you still get the same deductions as you would being a general partner. It's just depending on what type of income you have and what you're trying to accomplish from a tax standpoint.
Okay, so an investor would choose general partner shares if they want to offset income from their workaday job, or they're more likely to choose limited partner shares if they want to offset passive income from their real estate investment.
That's correct.
Okay. How do listeners get a hold of you to find out more, Mike?
Well, there's several ways. Obviously, you can call our 1-877-915-7333 number. We more than likely put you in touch with Garland Benton. He is with Reef Securities. Or they can go to our website at www.reefogc.com, and they can reach us either way.
All right. Well, I'm glad you offered them Garland there, Mike, because I'll just tell my listeners, Garland has been my broker for the investment ever since I got into it, and he's been really good with handling my questions as well as keeping me updated while these funds progress along. I've liked the investor login portal at your website at reefogc.com too, Mike. There are drilling reports as well as a log of all of my historic reef returns there at that site as well. So, hey, Mike, thanks so much for joining us today. I think my listeners have really found it insightful.
Thank you, Keith, for having me.
You've been listening to the Get Rich Education podcast, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.